All right, let's start with exercise 4-31 in your book, Cost Flows and Applying Overhead. We have the Erkins Company uses a job costing system with normal costing and applies factory overhead on the basis of machine hours. At the beginning of the year, management estimated the company would incur 1,980,000 of factory overhead. So we'll start there. Factory overhead, that's the estimate. Well, I'm sorry, 1 million. I got short of zero there. And um, and use 66,000 machine hours. So we divide that by 66,000. And so 1,980,000, 66,000 divide. And so we have a predetermined overhead rate of $30 per hour on that one. Okay, so that's actually the answer to number one. Compute Elkin's predetermined overhead rate for the year. And then number two says prepare the journal entries to record the events that occur in October. So we purchased 180,000 pounds of material on account. The cost was $5 per pound. So we'll just go down these. So journal entry A will be inventory, and that will be 180,000 times 5 will be 900,000. And we're going to, it was on account, so we've got accounts payable for 900,000, like so. Okay, and then we have B. We issued 120 pounds of materials to production, of which 15,000 was used as indirect material. Okay, so now B is going to have two entries to it. The first entry, we're going to take the 120,000 and subtract the 15,000. That means 105,000 pounds went to work in process, and 15,000. Well, it will go to manufacturing overhead control. So, and that's times 5. So we're going to have work in process inventory, and I put what it's for, materials. Technically, you wouldn't have to. 525,000. And then I'm going to have manufacturing overhead control, and that will be 15,000 times 5 is 75,000. And then we're going to take that out of inventory. And that will be 600,000. All right. And then C, we incurred direct labor costs of 240,000 and indirect labor costs of 40,000. So C is going to be work in process direct labor, and that was 240,000. Then we're going to have manufacturing overhead control for 40,000. And that will be salaries payable or wages payable, either one's fine, for 280,000. All right. Move down a little bit. We have D. We recorded depreciation on equipment for the month. So D is going to be manufacturing overhead control, right? And that's 75,700. The credit on this is going to be accumulated depreciation, 75,700. Now, if you think back to your financial accounting class, you probably put, when you saw depreciation, you probably wrote depreciation expense as the debit and accumulated depreciation as the credit. And that is correct. Again, if you're in a merchandising company or a service based company, something like that, or if you're in the home office and we're talking about the office furniture, those sorts of things, that would be the correct entry. But here, because we're in manufacturing, we've got that matching principle. The depreciation will not become an expense until we sell the goods and it becomes part of cost of goods sold because it's used in manufacturing. Okay, then we've got E. We recorded insurance costs for the manufacturing property, $3,500. So we'll have manufacturing overhead control, 3,500. And we could either, I'm going to go cash. It doesn't say here. It could be insurance payable, but I'm going to go with cash for 3,500. Insurance companies tend to like their money up front. Understandable, right? And F, we paid $8,500 cash for utilities and other miscellaneous items for the manufacturing plant. So F is going to be manufacturing overhead control. And 8,500. And that's what we said, we paid cash on that one for sure. And then G, we completed job H11 costing 7,500 and job G28 costing 77,000 during the month and transferred them to finished goods. Now you could do this in 2 or 1. That's fine. I'm going to go ahead and do it in 2. So we're going to put it into finished goods inventory. So H11, and that was for 7,500, and going to put that out of take that out of work in process inventory. 7,500. Finished goods, and that was second one was G28, was for 77,000, and that comes out of work in process for 77,000. You could do that as one entry, so it'd go into finished goods for 84,500 and come out of work in process inventory for 84,500. That's acceptable too, and that actually might be what they look for on your homework manager on that. Finally, flip the page here, and we've got one more. Shipped job G28 to the customer during the month. The job was invoiced at 35% above cost. Okay, so um, so our cost on G28 was 77,000, and we're told that we invoiced at 35% above cost, so 1.35 times would be 103,950. So we're going to have accounts. This is J. We're going to have accounts receivable for 103. And we know it's an accounts receivable because we say we invoiced it, right? And then that will be sales revenue for 103,950. We then have our cost of goods sold, which is the 77,000, and we take it out of finished goods inventory for 77,000. Okay, and then we're told in I that we use 7,700 machine hours in April. So we take the 7,700 and we flip back over the previous page. We see this is our predetermined overhead rate of $30 per hour. So we multiply this times 30, and we get $231. And this is going to be applied. So let's see. Oh, this was H. Sorry, this one is I. That's correct. Okay, so this is going to be work in process inventory. 231,000, and we're going to put that manufacturing overhead control of 231,000. All right. So that's number 2, and then finally number 3 is we're going to say compute the amount of overapplied or underapplied overhead and prepare the journal entry to close the under or over applied overhead. So I'm going to leave a space for the journal entry. I'm going to make a T account here. And this will be our manufacturing overhead control. And so we go back to each one of these, and we have manufacturing overhead control of 75,000. So we'll put 75,000 there, and we check that off. We have manufacturing overhead control here of 40,000. And we check that off. We have manufacturing overhead control of 75,700. That off, 3,500. Check that off. Manufacturing overhead control of 8,500. Check that off. No more manufacturing overhead control on this page. Double check. We've got that all. Go to the second page. And I've got manufacturing overhead control here of 231,000. Okay, so now I add these all up. 75,000 $40,000, 75,700, 3,500, and 8,500 gives me 202. Subtract the 231, 202,700, 231, and we end up with 28,300. Now remember, the left-hand side is the actuals, the right-hand side is the applieds. So we are over applied because we have a balance there. And so this is number 3. We're going to have our journal entry will be manufacturing overhead control, 28,300, 28,300. That brings us to 0. And we're going to close that out to cost of goods sold, 28,300. Once again, cost of goods sold is an expense. Expenses increase on the debit side, decrease on the credit side. And so we actually made more money than we thought we made here when we made, we thought we made, 26,950. We actually made an extra 28,000 above that. All right. So that is problem 31. Let's move on now to the next problem I picked out, which is number 4-33, exercise 4-33. And this is the Johnson Incorporated is a job order manufacturing company that uses a predetermined overhead rate based on direct labor hours to apply overhead to individual job. For the current year, estimated direct labor hours are 95,000 and estimated factory overhead is 617,500. The following information for September of current year, job A was completed in September, job B was started and not completed. Okay, so the first thing we need to do, the first requirement is what is the total cost of job A? Okay, so in order to do that, we're going to have to get the predetermined overhead rate first. So we know that we're estimating 617,500. And we know that we're basing it on direct labor hours. We're anticipating 95,000 direct labor hours. So this is a pretty big company when you figure 2,000 hours per worker. So we get 617,500 divided by 95,000. We get $6.50 per hour. Okay. So we want to know what the total cost of job A is. So job A, we have the beginning inventory. And it tells us here, work in process, all job A is 31,200. We have direct materials requisition, job A was 65,000. Direct labor hours, job B was 42,000, and if we go down just a little farther, the labor cost, direct labor is $8.50 an hour. So job A had 4,200 hours times $8.50 is 35,700. Okay. And now we have to apply the overhead, manufacturing overhead. We're going to use the $6.50 times the direct labor hours of 4,200. We get 27,300. We add those four numbers together and we get 35,700 plus 65,000 plus and the beginning inventory of 31,200 plus gives us 159,200. So that is our answer for part one. What is the total cost of job A? Then it says number two is what is the total factory overhead applied in September? So we have indirect or we have direct labor of job A of 4,200 plus job B of 3,500. Those two together times $6.50 is going to be 7,700. 7,700 times 6.5 is going to be 50,050. So that's the answer to number two. And then number three says, what is the over or under applied overhead for September? So if we look at our manufacturing overhead control, we know that this is the credit, 50,050, and we have to go through here and put together the actuals, right? And so if we go down here, indirect labor was 13,500. Supervisor salaries were 6,000. Rental cost factory was 7,000. Now they gave you administrative offices, but administrative offices are not a factory overhead, right? So we don't include that. That's kind of a red herring to get you to bite. But you don't include that because it's not not part of the manufacturing process. Then we go down to equipment depreciation costs. We have the factory 7,500. Again, administrative offices, the depreciation doesn't count towards the manufacturing, so we leave that out. And then we have indirect materials used, 12,000. Add those all up. We've got 13,500, 6,000, 7,000, 7,500, and 12,000. And that's 46,000. Subtract off the 50,050. We are 4,050 over applied. And so that's that answer. Then I'm going to go ahead and do the journal entry just to finish this out. It doesn't ask for it. I'm going to go ahead and do it. So we would have manufacturing overhead control and cost of goods sold. And that would do that. All right, so that is exercise number 433. The next one up that I have picked out is exercise 4-36. Okay, and 436 is application of overhead. Norton Associates is an advertising agency in Austin, Texas. The company's controller estimated that it would incur $325,000 in overhead costs for the current year. Because overhead costs of each product change in direct proportion to the amount of direct professional hours incurred, the controller decided that overhead should be applied on the basis of professional hours. The controller estimated 25,000 professional hours for the year. During October, Norton incurred the following costs to make a 20-second TV commercial for Central Texas Bank. Okay. And the industry customarily bills customers at 150% of the total cost. Okay, so the first thing we have to do is we have to calculate the predetermined overhead rate, and we are told it is 325,000 of estimated overhead for the year, 25,000 professional hours for the year, that's going to give us a predetermined overhead rate of $13. Okay, and we're told, so number one is compute the overhead rate. That's what we did. And number two, what is the total amount of the bill Norton will send to Central Texas Bank? Okay, so we start with the direct materials, and that's going to be 32,000. Then we have the direct labor. We're told that's 1,200. And then we need the manufacturing overhead. We're told that it was $50 an hour for the rate, so 1,200 divided by 50 is going to be 24 hours that we actually used, and we multiply that times our predetermined overhead rate of 13. So our manufacturing overhead is going to be $312. Add that up. We get 33,512. That's our cost, right? But that's not what we're going to bill. We're going to bill times 1.5, 150% of that. We are going to bill 50,268. All right, so that is exercise 4-6. And the last one of these that I have for you is problem 4-40. You can look at what I just did And that will, generally speaking, be about the level of difficulty you can expect on the exam. Those three problems, three exercises I just did on those. Okay, so 4-40. This one takes the predetermined overhead rate and expands it to doing departmental rates. So instead of a single rate, we're going to have two departmental rates. And in this problem, what they do is they compare doing it the single plant-wide rate or a couple of different, using a couple of different allocation bases, and then they look at departmental rates and see which one is a little more accurate, right? So we've got Rosebach was recently hired as controller for IMCO Inc., a sheet metal manufacturer. IMCO has been in the sheet metal business for many years and is currently investigating ways to modernize its manufacturing process. At the first staff meeting Rose attended, Bob Kelly, chief engineer, presented a proposal for automated the drilling department. He recommended that IMCO purchase 2 robots that could replace the 8 direct labor workers in the department. The cost savings outlined by Bob's proposal included eliminating direct labor costs and reduce factory overhead costs to zero in the drilling department because IMCO charges factory overhead on the basis of direct labor dollars using a plant-wide rate. IMCO's president was puzzled by Kelly's explanation of cost savings, believing it made no sense. Rose agreed, explaining that firms become more automated, they should rethink their factory overhead system. The president then asked her to look into the matter and prepare a report for the next meeting. And so describe the shortcomings of IMCO's system. Okay, so um, actually, I was looking at 4041. I thought it was all the same problem. So never mind, excuse that. I'm sorry. Let's look at 4041. Ryan Corporation manufactures auto steering systems. Prime cost and machine time estimates for 1 unit of the product for the year follow. Direct materials, $200. Remember, this is per unit. Direct labor, 12 hours at $300, and machine hours at $20. The product requires 15 hours of direct labor in Department A and 10 hours in Department B. Also requires 5 machine hours Department A and 15 machine hours in, those are hours up there. In Department B, using output as an activity. The factory overhead costs estimated in the 2 departments are as follows. Variable costs, $150,000 in Department A, $80,000 in Department B. Fixed costs, $93,000 in Department A, and $163,000 in Department B. Management expects the firm to produce 1,000 units next year. Assume that the factory overhead was applied on the basis of direct labor hours. Compute the predetermined plant-wide factory overhead rate. So the first thing we do is add up all these costs, A and B. So we've got 150,000. We've got 80,000. We've got 94,000. And we've got 163,000. And if we add those all up, we get 487,000. Okay, now the direct labor hours that we are expected to use is 15 for each product in Department A and 10 in Department B. So that would be 25 hours times 1,000 units would be 25,000. So now we take the 487,000 divide it by 25,000. Would give us $19.48 in direct labor hours for the single plant wide rate. If factory overhead were applied on the basis of machine hours, what would be the plant wide rate? So we'll have the same 487,000, but now our machine hours, we are told the product requires 5 machine hours in A and 15 machine hours in B. And so that would be 20 machine hours. 20 times 1,000 units would be 20,000. Would be $24.35 for a single plant wide rate using that. If you were, then number 3 says, if the company produced 1,000 units for the year, what is the total amount of factory overhead in each department requirements in 1 and 2? So in 1, we would have 15,000 times 1948 for A, and B would have 10,000 times 1948 we would have 292,200 goes to Department A, and $194,800. If we add those two together, we get 487,000. So we applied it correctly. And if we were to do the single plant wide rate based on machine hours, then we would have 5 machine hours times 1,000 would be 5,000 times 2435 in A, and we would have 15,000 times 2435 in B. That's 121,750. And in Department B, it would be 15,000. $365,250. So obviously, Department A would prefer the machine hour allocation basis, and Department B would prefer the direct labor hour allocation. And then 5, it says compute the departmental overhead rate and applied overhead for Department A using direct labor hours, and B using machine hours. So now we have to redo this. So A is going to be 150,000 and 94,000. which will be 244,000, and B will be 80,000 and 163,000. That'll be 243,000. Okay. Our direct labor hours in Department A, using direct labor hours. So 244. We use 15 direct labor hours times 1,000 would be 15,000. Would be 16. And I'm just going to round that to 27 is the single plant-wide rate, or is the departmental rate for A using direct labor hours, and B would be 243,000 divided by 15 machine hours in Department B. So again, that'll be 15,000. Will be 1620 per machine hour. So very, very close on those. Okay, so that is exercise 40-41. Since I teased you with 41, let me go ahead and answer those questions. They're just narrative questions. So describe the shortcomings of IMCO's current system for applying overhead. It doesn't take into account, the biggest shortcoming is it doesn't take into account that the two departments have vastly different uses of overhead and vastly different uses of the allocation base, especially if they go to an automated drilling process. They would go obviously cut down to zero, but the robots are going to obviously require depreciation, electricity to run, and space in the factory building. So that's a shortcoming there. Number two, explain the misconceptions of Bob Kelly's statement that the factory overhead cost of drilling would be reduced to zero. Well, the allocation would be reduced to zero, the overhead wouldn't be reduced to zero. What would happen was all that overhead would just get shifted to the other department, and so it would distort the actual costs of the other department. And it would distort too low the cost of the drilling department. And how would you improve the allocation cost? Well, there's a couple of different ways. You could go to departmental rates like we did here. That's probably the best way to do things. You could also you could change the allocation base so that it better reflected what was used. Obviously, direct labor hours and direct labor cost would not be appropriate since there's no direct labor. But you could change the allocation base to machine hours. That might be better depending on how much machinery the first department. So those are two ways to improve that. All right, so I hope that was beneficial, and please let me know of any problems, difficulties that you have addressing these, and we will talk to you later.